Welcome back to Smart Stock Sam, the channel where we cut through the noise, ignore the hype, and find the trades that actually move the needle. I'm Sam, and today we are talking about a stock that has done something so statistically improbable, so historically unprecedented, that when I first pulled up the chart, I genuinely thought my screen was broken. What if I told you that a company most people associate with those little blue storage cards they used to shove into a digital camera back in 2009 just posted a gain of over 4,000% in a single year? Not 4%, not 40%, 4,000%. And here's the part that should stop you cold. This wasn't some speculative startup burning cash on a dream. This is a real company with real earnings, real contracts, and real institutional backing at every level. The name is SanDisk. Ticker SNDK. And before you say, I missed it, it's too late. Stay right here, because the story is nowhere near finished. But here's the thing. While the fundamentals behind this stock are genuinely jaw-dropping, there is a hidden signal buried deep inside the derivatives market right now that every retail investor needs to see before they do anything with this name. And that is exactly what we are going to unpack today. We are going to walk through the raw price action, the earnings numbers that shattered every model on Wall Street, the $42 billion contracted backlog that nobody is talking about loudly enough, the institutional money flowing in and quietly flowing out, the technical setup, and finally, the one options market red flag that suggests the smartest money in the world is quietly buckling its seatbelt, even as they hold their long positions. If you are new here, hit that subscribe button right now because this is the kind of deep dive you simply will not find anywhere else. Let's get into it. Let's start with the price action, because the numbers here are almost offensive to look at. On May 21st, SanDisk opened at $1,377 a share and closed the day at $1,542. Volume that day, 13.7 million shares. That is not retail activity. You do not move a stock this heavy, this fast on Reddit posts and TikTok hype. Fast forward to June 1st. The stock gaps up, opens at $1,731, rips to touch an intraday 52-week high of $1,804, and closes at $1,761, a nearly 4% gain in a single session on nearly 9.6 million shares traded. Every single one of those shares was a decision. Somebody wired enormous sums of money into this position, and when institutions move money at that scale, there is always a reason. So what is that reason? 2 words: the earnings. Let's look at what SanDisk just reported, because I promise you, this is the part that rewired every hedge fund analyst brain overnight. For the third quarter of fiscal 2026, SanDisk posted revenue of $5.95 billion. That is a 251% year-over-year increase. Let me say that differently. In the same quarter last year, they made roughly a third of what they just made. But the number that truly caused chaos on trading floors wasn't the revenue. It was the earnings per share. Analysts, the smartest people with the most data in the world, were modeling somewhere between $12 and $14 per share in non-GAAP earnings. SanDisk came in at $23.41. They didn't beat the estimate. They didn't crush the estimate. They obliterated the entire conceptual framework of what a memory company was supposed to be capable of earning in a single quarter. When that happens, fund managers don't just update a cell in a spreadsheet. They throw the entire model in the trash and start over. And when they start over, they buy more stock. But here's the question that should be burning in your mind right now. How does a hardware company that used to fight for thin margins on commodity flash storage suddenly print those kinds of numbers? The answer is in the margins, and this is where the story gets truly extraordinary. SanDisk's corporate gross margin just leapt from 22.5%, a standard, cyclical, hardware-typical margin, to 78.4%. That is a software company margin. That is the kind of margin you expect from a platform business, not from a manufacturer of physical storage chips. And the reason for that transformation is their enterprise data center segment, which grew by 645% year over year to pull in $1.47 billion. Think about what that means architecturally. The AI infrastructure build-out is not just a story about graphics processing units and compute power. It is increasingly a story about where all that data lives and how fast it can be accessed. AI models doing real-time inference, reasoning over massive datasets, making decisions autonomously. They are starving for memory bandwidth. SanDisk found a way to be the company that feeds that hunger, and hyperscalers are paying software-like premiums for that capability. Which brings us to the single most important piece of information in this entire video. What could make even the most bullish institutional investor suddenly decide it was time to add massive downside protection to their long positions? I'll tell you in a moment. But first, the fundamental anchor that makes this stock categorically different from every other AI trade you've seen this cycle. Memory markets are historically brutal. Prices spike, supply floods in, prices crash, companies bleed. It is a cycle as old as the semiconductor industry itself. SanDisk's new management looked at that cycle and decided to completely detonate it. They went out and locked in 5 multi-year supply agreements with major hyperscalers, the biggest cloud providers on the planet. And these aren't handshake deals. These contracts total $42 billion in minimum revenue commitments, backed by over $11 billion in financial guarantees. Do you understand what that does to an investment thesis? It converts SanDisk from a volatile commodity play into something that looks much more like a toll road. The cars have to pass through. The revenue is committed. They are, for practical purposes, printing guaranteed money for the next 3 years. And the technology that justified those contracts is coming. In the fourth quarter, SanDisk is launching the QLC Stargate platform paired with their proprietary high-bandwidth flash architecture. As AI systems become truly agentic, meaning they don't just respond to prompts, they autonomously take actions, plan sequences of tasks, and reason over enormous datasets continuously, the storage demands for those workloads become exponentially more complex than anything standard solid-state drives were designed to handle. Think about what it means for a model to be running thousands of simultaneous inference requests while simultaneously accessing petabytes of training context. Standard storage simply cannot keep pace with that demand curve. High-bandwidth flash is purpose-built for exactly this use case. It is the critical infrastructure layer that sits between the compute and the data, and without it, the most powerful AI systems in the world would be throttled into uselessness by the simple physics of data retrieval latency. SanDisk is positioning itself as the unavoidable toll booth on the highway to artificial general intelligence, and Wall Street, to its credit, is finally listening. The analyst upgrades have been absolutely ferocious. Barclays moved from equal weight to overweight, nearly doubling their price target from $1,200 to $2,300, citing that $42 billion contract floor as the primary justification. Mizuho maintained their outperform rating and raised their target to $1,825. And then there is Susquehanna, who has set the boldest flag on the street with a price target of $3,250, anchored in a thesis that tight NAND supply will persist well into 2027 and that this margin expansion is entirely structural, not cyclical. When analysts from 3 different firms across 3 different methodologies all arrive at broadly the same conclusion, that is not groupthink. That is convergence around a genuine industrial shift. But I want to show you something that is more telling than any analyst note, because what the smart money says and what the smart money does are often 2 entirely different things. Right now, institutional investors hold approximately 87% of SanDisk's outstanding shares. Stanley Druckenmiller's Duquesne family office recently closed out a position in Alphabet to initiate a $24.2 million stake in SanDisk. David Tepper's Appaloosa Management added over 280,000 shares. When investors of that caliber make that kind of rotation, it is worth paying very close attention. But here is the warning signal that every serious trader should be aware of. Renaissance Technologies, the legendary quantitative fund, trimmed its SanDisk stake by over 33% in the first quarter of 2026. Rentech runs mean reversion models. When they reduce a position this aggressively in a stock that has already run this hard, their algorithms are telling them the risk-reward in the short term has shifted. That doesn't make it a sell. It makes it something you need to manage carefully. And the insider activity? Context matters enormously here. CTO Alper Ilkbahar and Chief Legal Officer Bernard Scheck both disposed of shares on May 25th. But if you read the actual SEC filings, these were purely administrative, tax withholding transactions tied to vesting. There is no open market dumping by executives. In fact, when the company recently faced a predatory mini-tender offer trying to buy shares at a deeply discounted $1,150, the board aggressively rejected it and told shareholders to do the same. Management is not running for the exits. They are standing at the door telling you the house is worth more than anyone is offering. Now let's talk about what the chart is actually telling us, because the technical picture right now is fascinating in a way that demands your full attention. SanDisk is currently above every major moving average that matters. It trades comfortably above its 20-day simple moving average at roughly $1,698 and its 50-day at $1,604. All 12 major moving averages are signaling buy across multiple time frames. The MACD sits at 47.59, firmly in bullish momentum territory. But the 14-day Relative Strength Index is hovering just under 66. That is dangerously close to overbought. Not there yet, but close enough to demand discipline. Meanwhile, short interest sits at just 6.26% of the float, with a short interest ratio of barely 1.02 days to cover. The institutional bears are not fighting this stock. They are standing aside, which means if we do get a pullback, it won't be fueled by forced short covering. Any dip will require real sellers, real profit-taking, real rotation. And that brings us to the hidden signal I promised you at the beginning of this video. The one piece of data that the smartest money in the room is quietly screaming at you. On June 1st, options volume on SanDisk exploded to nearly 120,000 contracts in a single session. That alone is remarkable. But here is what made me stop and stare at my screen for a full 60 seconds. 64.7% of that volume was in put options. Less than 35% was in calls, on a stock that just posted 251% revenue growth and has $42 billion in contracted backlog. Why would anyone be buying that much downside protection on a fundamentally bulletproof stock? The answer is institutional hedging. The big funds that are sitting on hundreds of millions in SanDisk gains are not stupid enough to ride those gains all the way back down if the market decides to take a breather. They are long the stock and simultaneously buying puts, paying for insurance. This options skew is not a death sentence for the bulls, but it is the market's way of telling you, in plain language, that a short-term consolidation, or a sharp dip, is very likely coming. The seatbelts are going on. And if you are thinking about a new entry, that is your signal to wait for the right level rather than chasing at the highs. Because every bull thesis has a pressure point, and SanDisk's is this. Everything working in their favor right now depends on supply remaining tight. If Samsung or SK Hynix announce massive capital expenditure programs to build new fabrication plants and flood the market with NAND flash at lower prices, those 78% margins will compress fast. And at a forward price-to-earnings ratio as elevated as this stock currently carries, any stumble in execution on that $42 billion backlog will trigger an immediate and violent repricing. Ask yourself honestly, could either of those supply giants decide that SanDisk's premium pricing is too attractive an invitation to let slide? History says yes. The AI demand story is essentially infinite. The risk is not demand. The risk is that SanDisk is competing against companies with virtually unlimited manufacturing capacity and a strong economic incentive to take market share. Keep that risk front and center in everything you do with this name. So how do we actually trade this into the week of June 2nd? The directional bias here is bullish, but structured and hedged. Given the heavy put volume signaling that institutions are expecting a dip, the ideal setup is to target an entry around the classic pivot point support level at $1,741.88. If you prefer confirmation over prediction, wait for a sustained volume breakout above the June 1st 52-week high of $1,804 before adding any new exposure. The short-term price target aligns with Mizuho's upgrade level at $1,825. And you must, I cannot stress this enough, you must respect a hard stop loss at $1,686, which sits just below the most recent intraday low. In a market where sector-wide profit-taking can erase weeks of gains in a single afternoon session, that stop loss is not optional. It is the difference between a managed trade and an account-defining mistake. Now, before I give you my final verdict, I need to be very clear about something. Nothing you have heard in this video is financial advice. I am not your financial advisor. I am not your broker. The analysis presented here is for educational and informational purposes only. Every investment carries risk, including the complete loss of principal. Past performance, even a 4,000% run, does not guarantee future results. Always do your own research. Always consult with a qualified financial professional before making any investment decision. Trading stocks, options, and derivatives involves substantial risk and is not appropriate for every investor. The scenarios and trade setups discussed here are illustrative only. Please invest responsibly. With that said, here is the bottom line. SanDisk has executed one of the most remarkable business transformations in the history of the semiconductor industry. From commodity hardware vendor to AI infrastructure linchpin, from 22% margins to 78% margins, from volatile spot pricing to $42 billion in locked-in contracts. The structural case for this stock over a multi-year horizon is as strong as anything I have analyzed on this channel. But in the short term, the options market is waving a yellow flag, Rentech has quietly reduced its exposure, and the RSI is knocking on the overbought door. This is a stock you hold for the long term and trade strategically in the short term, buying structural dips near the 1740 support zone, respecting your stops, and letting the AI infrastructure supercycle do the heavy lifting over time. Now I want to hear from you. Here is the question I want you to answer in the comments below. Given that 64% of June 1st options volume was in puts, do you think the institutions buying that protection know something specific, or is this purely routine portfolio hedging on a massive winner? Drop your answer below. I read every single comment, and I want to know where your head is at. If this breakdown gave you even one edge you did not have before you clicked play, please hit the like button right now. It genuinely helps more people find content like this. And if you are not subscribed yet, what are you waiting for? Hit that subscribe button and ring the notification bell so you never miss another setup. Now, if you are serious about leveling up your investing and trading, I want to personally invite you to join the Smart Stock Sam members community. This is where we go deeper than any public video can. Members get trade setups in advance before they go public, custom equity analysis, a private community of like-minded investors, and priority replies to your queries. If you made it to the end of this video, you already know this is the level of research you want every single week. The join button is right below. Tap it and let's level up together. And if you really want to support Smart Stock Sam and help us keep producing this level of research, you can also send a super thanks directly through YouTube. Every single one of those is seen, appreciated, and goes straight back into making this channel better for you. Thank you for watching. Stay sharp, stay disciplined, and I will see you in the next one.